Good morning, everybody, and welcome to BDO's Law Series webinar, Conquering the World, Expanding Business Across Borders. First up, apologies for the very late start here. We just had some technical issues with respect to the slides. So what will happen with the slides is they will be uploaded shortly to the Materials tab on the GoToWebinar. So you should be able to download those when they're uploaded. So give us a couple of minutes and those slides should be available for you. Because we're not able to share them, we'll ask you to download those and go along through them with us as we proceed. Anyway, before kicking off properly, I'd like to acknowledge the traditional owners and custodians of the land on which we meet today, which here in Melbourne is the Wurundjeri people of the Kulin Nation. We pay our respects to elders past and present and celebrate the diversity of Aboriginal people and their ongoing cultures and connections to the lands and waters of Australia. Some housekeeping from a webinar perspective. You're all automatically muted, but we will be accepting questions throughout the session, and you can submit those using the question tab. So feel free to drop your questions in as you go. We'll either hit them as we go along or pick them up at the end. We'll try to get to as many as we can. However, if we can't, we'll certainly try to follow up with you after the webinar concludes. If you experience any technical difficulties, just click the support button, which is one of the bottom tabs on your screen. And finally, this session is being recorded and all registrants will receive a follow-up email containing the slides, a link to the recording, access to other webinars in this series, and contact details for all of us. I see a message there from Michael saying, can't see the camera. Stacey, let me know if that's a problem just for Michael or if that's a problem for everybody. In the meantime, we will carry on. So today's presenters, there's three of us here, as you can hopefully see. My name is Michael Smith. I'm a partner in the transfer pricing team here at BDO based out of Melbourne. I'll ask my fellow presenters to introduce themselves as well. Leonie, would you like to go first?
Oh, thanks, Michael. So Leonie Ferreter, I'm the National Trade and Customs and Excise Partner for BDO.
And
You're
Gary?
on mute, Gary.
Good morning, everybody. My name's Gary Poon, Corporate Tax Partner in the Melbourne office, and I would have thought that I got plenty of practice after COVID to turn my mute button on, but apologies.
Thanks, Gary. And maybe a quick first question to our panelists. Why are there only three of us? How many of us could we possibly have had here to talk about expanding internationally?
Well,
Who else could we have had, do you reckon, Gary?
I think, you know, when we thought about this topic, I'd added a few other bullet points, and we thought, well, we can't have that many other people on the webinar. So there's at least 2 or 3 other specialists that could be on this webinar, Mike.
Yep, that's it. I think we probably figure that we don't have GST or employment taxes or immigration covered today. We're going to focus on sort of corporate tax and customs duty related issues, which should be half at least of the battle, but just to let you know that there are certainly plenty of other angles to cover. So in terms of the slides, as soon as you can download them, on slide 5, you'll see a fantastic word cloud that summarizes all of the different tax-related issues that could apply when a business looks to expand across international borders. You have to take my word for it for now until you can download the materials, but it is certainly a very busy slide. Lots of words on there like business structure, transfer pricing, customs valuation, corporate residency, funding, VAT, taxation of financial arrangements, tariffs, etc. So Leonie, Gary and I, we're all experts from a tax perspective. We all specialize in different areas of tax. But the purpose of this webinar series is, of course, to reach out to our legal friends and ask you where there are things that we might talk about from a tax perspective that have a legal aspect. Please do put those in the chat. In other words, you know, we are certainly aware of some areas where there would be legal advice required in respect of the issues that we raise. But I think it would be awesome if you could also just put in the chat. Oh, and Katya's not been able to hear or see anything as well.
Okay. So, I can't see the chat, Michael, actually either, which is problematic.
It's in the questions box.
Yeah.
So maybe someone can add to the question box if they actually can hear and see us, just so we
Yeah.
know that it's
Because
not just
I
us.
can't see any questions in the question box.
Yeah. Thanks, Bonnie. Thanks. Awesome. Great. Thank you, guys. At least we're not just sort of howling at the moon on
Talking
our
to
own here.
ourselves.
So, right. Wow, what a combination. So we're seeing the Q&A box here, and we've got an absolute mix of everybody, not some being able to hear us, some being able to see us, some both, and some nothing. So again, apologies for the technical issues, similar to the materials, which should be free to download in a second. For those of you who can hear and see, thank you for responding, and we'll carry on in the hope that most of you can. So I was talking about the beautiful word cloud, which talks about all the tax issues, and obviously asking you guys please to put into the chat or to the Q&A, if that's the box available to you, some of the legal aspects as we go through, because that will certainly be useful for us, because when we're talking to our tax clients about tax matters, that will give us the opportunity to identify the legal matters and be able to reach out to you guys for opportunities. So moving on, here we are. It looks like the materials, the slides are now available in the materials tab. So if you would like to click on the PDF document, you should be able to download that and access the slides and follow along with us as we go. I'll give you all a second to do that. And any problems with, yeah, thanks Paul, thanks for confirming being able to download the slides, that's great. Awesome. All right, good job team, we'll get there. Okay, so in terms of the slides, I was just speaking to the slide that talks about expanding across borders can lead to many tax-related issues. So if you'd like to follow along, that's the one to start with. I'm actually going to hop from that one to the next slide, because clearly there's a whole host of tax-related issues that will arise when expanding business across borders. But the challenge is often where to start, where to begin. And I'm conscious that, you know, Leonie and Gary might have different points at where they begin. What I've done is taken a typical project plan and in good Melbourne fashion, deconstructed it for the purpose of this slide. So what I'm going to do is ask my panelists to talk about, in relation to the things we have on here, where they would begin and why, and what the relevant issues might get flushed out as we go. So let's start with Leonie. Looking at slide where to begin, all the different headings. So the big grey boxes are basically the kind of stages, and then all the bullets are all the detail. Where would you begin if you had a client come to you and talk about expanding across international borders?
Sure, thanks, Michael. Well, actually, I would start at fact finding, but not just from a tax perspective. So as a person who deals with the cross-border movement of goods, I'd actually be exploring with the client what have they done in terms of understanding the market and where they're going to. I mean, great example, I had a client once who wanted to sell ice cream into China and immediately went to the largest cities of, you know, Shanghai and Beijing, and subsequently they flopped because all the big ice cream players internationally were already there. And so when they looked at the second tier cities, they found that they had great markets and those big guys weren't there. So from a person who deals with goods, I wouldn't start with tax, I'd actually start with market.
Yeah, thanks, Leonie. Always a good reminder. I'm sure it's the same from a legal perspective, to start with the commercials. You know, what's our client trying to achieve? Have they thought it through? And there might even be some advice we can give them before they get to the nitty-gritty technical stuff. How about you, Gary? Where would you start?
Certainly fact finding, and yeah, not surprisingly, a little bit of a different focus. I'd be very much focused on, okay, well, where you're going, what your initial first steps are. Is it setting up an office in that country? Is it working with a local third-party service provider? Is it just sending you know, one or two staff across? for a period of time, just to try and break the market. And all those kind of different possibilities does give rise to different tax considerations in terms of how to set up your initial structure or arrangement in that country. And so business structure being one of the first things to think about. But the other side of it is, well, all of this is going to cost you money to start off with. So how are you going to fund it? Is it, if you're sending staff across, then the funding is within the Australian entity. But if you set up a structure over there, well, how much capital are you going to put in? And myself and yourself, also Mike, from a transfer pricing perspective, would like to talk about what your mix of debt and capital is. So those would be the two very initial starting points of a fact-finding discussion.
Yeah, thanks, Gary. So I'll build on that. From a transfer pricing perspective, the fact-finding is critical because I'm looking to understand the basics, the organisational structure, so the legal structure, but also the personnel and the shareholders. So, for example, we'll have clients who are outbound and clients who are inbound, and depending on where the shareholders are, from a transfer pricing perspective, there might be different objectives that they might have. So, for example, they might want to maximise the amount of profit that they have in Australia, and the amount of franked dividends that they might be able to get from the business. Alternatively, they might have losses to use in overseas jurisdictions, so deferred tax assets. And therefore, from a transfer pricing perspective, there might be reasons to look to help them or guide them towards being able to recognise a higher amount of profit offshore, to utilise some of those losses and save them some cash tax. So having that big picture understanding of the business is critical in terms of advising from a strategy perspective. From a TP perspective, we also do a functional analysis, which is basically to understand the key functions, assets and risks, who's creating the value in the business, because ultimately from a transfer pricing perspective, that's where the profit should sit. So really, transfer pricing is one page of legislation, as compared, Gary, with you, with several books worth of legislation, but a lot of focus on facts and where people are. I'd also be looking to identify key related party dealings that might be arising as part of that fact-finding mission. So that's good. Good start. We've got our facts. What are we going to do next in terms of moving on through the journey of advising our clients expanding internationally? What's the next step, Gary?
Well, usually, after the fact-finding exercise, it's a case of working through with the client and within the grey boxes of the policy design. For corporate tax, that might look like written advice that's a bit more targeted to certainly the facts that we have uncovered in the first step. And in terms of the advice, generally clients would like to know, well, what's the usual setup that I can employ in that jurisdiction for what we're trying to achieve in the early stages. But typically, our advice would cover the entry and the operational. Clients don't always ask for it, but it's sometimes usually it's a good idea to also consider how to exit from that market as well down the track. And I guess from a policy design perspective, corporate tax, we would certainly reach out to the relevant office in the other country and try and get a sense of, well, what are some of the issues that we might consider overseas, and not just focusing on Australia, because ultimately you're looking to expand the world. So the overseas tax laws is what we don't know that we really need to bring in front of the client. So that our policy design from a corporate tax perspective does include a little bit of that as well.
Yeah, thanks, Gary.
Sorry, Michael. I think from my perspective, the overseas validation process is really important. So, we're in Australia, we have quite a liberal trade system, but a lot of jurisdictions require permits to import product. There are such things as prohibited imports. So you need to validate overseas whether or not you can actually even get your goods into that market. And similarly, what's required from an outbound perspective in Australia. So certainly if we're dealing with food products, and Australia does export a lot of food, there are a lot of quarantine regulations or biosecurity regulations that need to be complied with. And the requirement to get permits can certainly impact on your timing to market. So, you might want to set everything up and go straight in, but if it's going to take you 6 to 12 months to get permits to actually import and supply goods in that country, you've got time to, kind of plan properly.
Yeah, thanks, Dione. Just seeing a couple of questions come in. If anyone's joined late, you can access the slides in the materials tab. So feel free to download those and follow along. We're currently on the slide that's titled Where to Begin. So we're talking about the policy design stage. From a transfer pricing perspective, there might not just be one option. There could be multiple. So when I have clients that are looking to go overseas, they might be commercially deciding how many people to put on the ground. Obviously, the transfer pricing is driven by the commercial aspects, but there might be different permutations around where contracts are signed, who they're signed by, where the revenues might sit, and therefore what the related party dealings might look like. Because ultimately, the transfer pricing, it impacts the debits and credits, impacts the P&Ls and balance sheets of the entities. So there's obviously different ways that can be done. So for me, when I'm doing policy design, I'm generally saying to my client, there's 2 or 3 different ways you might be able to do this. We'd be led by the commercials. But if you wanted to steer towards one or the other, it can certainly have different outcomes in terms of where your profits might sit. And then obviously from a corporate tax perspective and from a duty perspective as well, in terms of what the tax implications or potential leakages could be in relation to those different options. So that probably takes us on to number 3. What would you do next? So Gary, after you've done your policy design, I've probably segued into it quite nicely for you.
Yeah, so part of, or not necessarily always part of, but it's a good idea, is part of providing the written advice with, as Mike said, multiple options, is actually to say, well, what, numerically, how does that play out? Assuming $100,000 of revenue or some starting point. And so the financial modeling part of it, and for TP, the benchmarking, is something that when we deal with our clients, we're typically dealing with the finance team, so that they're numbers driven, and giving them a nice piece of advice is great, but actually they just want to know, what does this actually look like if I choose one particular business plan, and that is from the perspective of what structure versus no structure versus just working with third parties, and working through both the outcomes in that foreign country from a tax perspective, and then having that flow up into the Australian entity. And if they're private groups, typically they'd also want to know what the outcomes are for the shareholders. So the financial modelling part of the all the grey boxes is a very logical place to next go to.
That's it. And we're as accountants, we love numbers, we love a spreadsheet, so that's probably one of our strengths. But the numbers obviously can illuminate those options and tell you which is best. So, for example, I was working with a client last week that had an older transfer pricing policy that basically let them have overseas distributors that would pay back a fixed percentage of their income as a royalty. However, it would let them earn increasing amounts of profit overseas. However, they had a huge amount of losses in Australia to use. And from a transfer pricing perspective, the way they'd set up those distributors, it actually made sense to cap the returns earned by those distributors overseas and bring the residual profit back to Australia. So in that situation, comparing scenario A, which was their current policy, with scenario B, which is probably the more appropriate transfer pricing outcome, they could see that they could save tens of millions of dollars by revisiting the policy. And that obviously helps as well when you're talking to clients from a cost benefit perspective, to articulate, this is how much it might cost to get it done and done well, but ultimately there could be some savings here, and let's quantify those. Leonie, do you get the spreadsheets out as well?
No, not necessarily. necessarily. I leave that to the bean counters, Michael. But I think from an implementation perspective, one thing to note is that every jurisdiction is quite different. So there are different registration requirements in country, and whether that might be a VAT or GST requirement, and all of those things take time if you're going to be moving goods cross border. So certainly, you're going to have to do that early days.
Yep, perfect. All right. So going back to our slide, we've found our facts, we've designed our policy, we've done some financial modelling to work out which is the best outcome out of the various different options. Where to next, Leonie?
So documentation, Michael?
Oh, look, I'd probably do some overseas validation first. But
I've already done my overseas validation.
You've already done it. There you go.
I've already done it.
If you haven't already done your overseas
you go ahead and do that. And then you document it, and then I'll use your documents to support our customs positions.
Yeah, interesting. So from a transfer pricing perspective, I would go at slightly different order. I would go overseas validation, then I would probably go implementation, and then I would go documentation. And I might come back to why in a second, but it's good to note that there's different sort of levels of importance on each of these steps when it comes to different types of tax that you're dealing with. So maybe just pausing to go through the overseas validation, just in case we haven't done that in enough detail already. Gary, what does overseas validation look like for you when you've got an international tax policy?
It's crucial. Ultimately, we know what we know in Australia, but we don't know and shouldn't advise on the overseas tax outcomes. So the validation process really is part of. It could be structured in a number of ways, but typically it's part of the advice / financial modelling piece, because you can't really do a model without knowing the overseas outcomes under a particular sort of strict scenario. And that validation is one where a bit of work is done on our side, and we flick it over to our colleagues overseas and ask them, well, what are we missing? Fill in the blanks, and we work together, obviously, on an engagement to ensure that their input is complete and accurate for the scenario that we're trying to map and trying to model, and then it flows back up to us and then to the client. There's things that you focus on, like tax rates, withholding tax, any particular unique sort of treatment for certain types of transactions, which are more related to the, related party types like royalties or interest and the like. And different countries have slightly different ways of looking at those related party transactions as well. So you can never really assume that you know it by looking at the treaty. You'd have to really speak to the experts on the ground.
Yeah, and in transfer pricing world as well, it's easy to get carried away because the rules are similar in lots of different jurisdictions. So the OECD has put out guidelines from a transfer pricing perspective, but I would say that kind of gets you 70 to 80% of the way there from a transfer pricing perspective. So practically, when we work with clients, it makes sense to centralize that 70 to 80% effort, because what you can do is you can work through what the alternative policy options might be, and then go and get the preferred policy option validated by an overseas team. And that saves basically sharing multiple permutations or options with the overseas team, and effectively having them come back to you and spend a whole boatload of money and time coming up with ideas and thoughts on all three. So the combination of the policy design and the modelling being done from Australia when it's us doing it, or even from overseas when it's our overseas colleagues leading that part, is useful, not just because we get the right sort of sign-offs at the right time, but also because that way we minimise and mitigate the cost to the client, rather than having our overseas teams sort of boil the ocean considering everything as well. So I have also seen with the overseas validation lots of local nuances. Rarely showstoppers, but occasionally they can be showstoppers. And occasionally there's what I would call gotchas in terms of local rules and requirements that might do something unexpected. When you think you set a great policy, you've got a great plan, but the local tax laws will operate to give you a problem. I can give you a practical example of one of those. So I had a client that was expanding into the US. They set up an arrangement whereby the Australian head office provided some services to that US business, and the service fees were charged across to the US at a cost plus. And that's absolutely fine. But in the US, it turned out that if the service fees weren't paid, as in cash settled, within the financial year in which they were incurred, then a tax deduction couldn't be taken in the US until the following year, when it presumably had been paid. So what that meant for my client, who didn't take advice at quite the right time and get that international validation, it meant that they had to add back a whole load of expenses in their US tax return and pay a load of US tax when the whole business otherwise wasn't yet in a profitable situation. And it's purely because of the timing of the cash settlement of that intercompany invoice. So when I talk about gotchas, I talk about things like that. Having calls with overseas teams to understand the lay of the land and ask what those gotchas might be is kind of critical as well. Anything else to add from an overseas validation perspective, Leonie, or should we continue?
No, I think we can continue on.
Yeah, awesome. So I think then we had a bit of dispute about whether we implement or document next. And for me, like, you know, you would do both generally over a period of time. I'll talk about transfer pricing briefly first, because from a transfer pricing perspective, if you help your client implement something that's appropriate, then they shouldn't, assuming it's been done well, designed well, and implemented well, it shouldn't incur transfer pricing related adjustments and penalties. And documentation from a transfer pricing perspective tends to provide penalty mitigation as its primary objective. So if you're not going to have an adjustment, the value of the documentation is limited. Of course, you never can tell if you're going to have an adjustment, but you can certainly have an assessment of the level of risk. So for me, I would put implementation first when I was talking to a client, because it's more important to book the income and expenses related to transfer pricing and get those right than it is to document it first and book it after. Getting that right is really key. Anything to add to sort of implementation or documentation, Leonie?
So the only comment I'd make in relation to that, Michael, is depending on the jurisdiction that you're working in, a number of jurisdictions have what's known as customs reconciliation schemes. So they are schemes whereby you might have a transfer pricing adjustment, and it's an importer distributor. They should have registered for those value reconciliation schemes beforehand. And one of the requirements for most customs value reconciliation schemes for transfer pricing adjustments is that you have documentation in place at the time you start importing. And it's known that you might have an adjustment. Otherwise, it can give rise to penalties and interest when you have a transfer pricing adjustment that relates to goods. So I think we see some of like natural tension always between some of the taxes and how we go about things. And that's, I think, one of the important reasons we have to work together when we are working with clients, going offshore, because some of the taxes kind of butt up against each other. And whilst TP and corporate tax might do one thing, we would want it done another way for customs if there's goods involved.
Yeah, thanks, Leonie. Agree. And probably the key message from that is that if you are an expert in customs or tax or transfer pricing, going it alone is a risky thing, because there are, and even as we mentioned on the call, there's other types of tax that we don't have covered here today, such as the VAT or the expatriate side of things. Going it alone is terribly risky these days. I have seen in the past amazing transfer pricing structures that didn't consider the controlled foreign corporation rules, for example, where all the profits was attributed back to Australia, regardless of all the fancy work that was done. So those things can happen if you don't have the right people at the table. Gary, implementation, documentation, what do those mean for you in corporate tax world?
Well, certainly the setting up the structures, and this would be done by the overseas office if they can do that. And in some countries, it's the lawyers who end up doing that work, and in others, it's the accountants. But the setting up and then the business type registrations, which I would expect in a lot of cases would be done by lawyers in foreign jurisdiction. So very much implementation is here's the structure. It's set up, here's the money, here's the equity, here are the directors that need to be appointed if it's a company structure, or these are the local, so the foreign registrations for the Australian directors in respect of a branch. It's all of those administrative things that if you don't do it, you don't really have a way to legally operate in that country.
Yeah, thanks, Gary.
Documentation wise, it's probably more it's more about saying here's the original advice we gave you, so if it's still fit for purpose for your implementation, let's just make sure you follow the advice and not miss any steps by accident. And sometimes that means we follow up and make sure that the foreign advisors, whether they're a VA network office or if they're a local law firm in that country, that we still work closely and make sure that what they do is actually what is required.
Yeah, thanks, Gary. And the last thing I'll mention from an implementation perspective is intercompany legal agreements. And it's nice to be preaching to the converted on the call for a change, because I expect all of you legal folks will understand the importance of appropriately worded legal agreements. Now, in transfer pricing world, they are also extremely important. For example, in Australia, if there's a consistent line between what we call substance and form, so form is legal form and substance is economic substance, then the tax office here in Australia doesn't have the ability to reconstruct the transaction and call it something else. Instead, you would argue, if you were going to argue, about the price of that transaction. And that can sometimes be really important. The challenge is convincing clients that the intercompany agreements need to be done well, not just be some sort of a standardized, templated type of arrangement. And any thoughts that you guys on the call have about how to convince clients that intercompany legal agreements are absolutely worth spending the money on, because we believe so, it's just difficult to get them over that line, would certainly be welcome. Feel free to post those in the Q&A or the chat boxes, whichever you have access to. Just a quick check as well, for those who have joined more recently, you can access the slides from the materials download tab. We're having some technical issues with showing those on screen, that's why you can't see them. We are currently on slide where to begin. Now, I think we're getting close to the end of that slide. I think we've ticked all the boxes apart from year-end review and monitoring. Maybe Leonie, I'll go to you first on that one. What does year-end review and monitoring mean from a customs duty perspective?
Yeah, well, I suppose the first thing that I alluded to earlier was transfer pricing adjustments. So most countries will require the transfer pricing adjustments be examined to determine whether or not they should fall within the customs value of goods. Kind of back to your legal agreements and and the documentation that you have from a transfer pricing perspective. What is it that these adjustments relate to? Traditional model for importer distributors is using a transactional net margin method. They basically all you do is import and distribute. Most customs authorities take the view that any adjustments should be attributed to the goods. And so that's assessing how that process happens and making the relevant voluntary disclosures to protect your clients from penalty. The other thing that I think a lot of clients don't think about is actually reviewing what the customs brokers in each of the countries have done and whether they're accurate. So whether or not they've been over or underpaying customs duty. Basically, customs brokers they process the documentation as the goods arrive into the country. And they can get it wrong because they're charged with getting the cargo to the ultimate destination and not incurring storage. So we find it's always worthwhile to do a 12-month review on what actually duties that you've been paying and can you have minimised that, or is there risk there by potentially underpaying duties. So that's what that means for me.
Thanks, Leonie. Gary, any last comments on the monitoring side of things?
It's more the typical tax agent, tax planning type discussion, but in the context of first year or second year going outside of Australia, looking at whether there should have been payments that are made from the overseas business to Australia, like an interest or royalty charge, and if that was designed as part of the policy, then have they been paid or will they be paid by year end? Is there any withholding on them, and have the withholding been remitted in the local jurisdiction? And if there's filing obligations in relation to that the overseas office has actually done that or has that in the calendar of obligations.
Yeah, thanks, Gary. And certainly the administrative penalties, particularly for large multinationals, can be quite steep these days. In Australia, missing a withholding tax disclosure or form can lead to penalties in the multiple hundreds of thousands of dollars. So just having the good hygiene and governance around those things is absolutely critical as well. Not that the penalties are generally so large overseas, but it's one to watch out for. All right, so for those of you following along with the slides, we'll move on to the next slide now. What we have is a couple of practical examples. We have a expanding overseas via a company example, a very brief expanding overseas via a branch example. We'll then talk about an opportunity from a duty perspective for first sale, and then we'll wrap things up and have some Q&A. So a couple of practical examples to bring the theory that we just talked about to life. So moving on to practical example number one, incorporating a foreign company. Gary, do you want to speak to this one first?
Sure. This is fairly typical, and with the US, I mean, there's different versions of companies and LLCs that can be formed, but I've just for the sake of example, a vanilla company there that is treated as a company in the US. So with this example, and not necessarily on the slide, but is an important tax issue is, do we know who the directors are? Do we have enough directors in the US? Possibly there might be at least one required. Who are the directors in Australia that would be a director of that company? Are there going to be any corporate residency issues because there's one director here, one director over there, or two directors over here and one director over there? And making sure that that company's corporate governance in relation to board meetings and directors' resolutions are actually done well and in accordance with the local law, but also done in a way that hopefully doesn't trigger that US company, as the diagram suggests, to actually be an Australian tax resident. So that's a key topic of advice for us when we go off and provide advice around going overseas. Another aspect that's sort of flagged on the slide is around funding, which I've mentioned a number of times. There's many areas of the tax law that deal with funding, debt equity rules, the taxation of financial arrangement rules, ThinCap rules, and of course Mike's area around transfer pricing for pricing the debt and whether, or pricing the instrument and whether the instrument can actually be classified as debt. So that funding element is a key piece in an example like this. And I guess another area that was sort of flagged on the slide is coming back to the modelling is, well, how much profits do we want to leave in the US and allow the US to tax it versus how much do we want that to be brought to Australia via royalty payments, management fees, interest, any services really that Australia provides should actually be recharged anyway, but different forms of payment can give rise to slightly different tax outcomes. There's withholding tax for interest and royalties, but as far as I know for the US, there's no withholding tax for management fees, but as Mike mentioned, there's a gotcha scenario on that particular item that if you don't know, you don't know. Um, I guess a further element of discussion is probably around the fact that it's the US we've got in the example, not another country like Singapore, an example. So the US doesn't, generally speaking, attract our controlled foreign company rules, but other countries, especially lower tax jurisdictions, there is controlled foreign company rules that can apply and really just bring home everything that is taxable in that country anyway. So sometimes these what we refer to as CFC rules can also play a part in the discussion as well. I might just stop there for the moment because I could probably go on for another 5 minutes.
Yeah. It kind of comes back to the word cloud that we had on the one of the first slides. There's a number of different corporate tax issues that might apply, right? And while broadly the suite of tax issues might be similar, they're going to apply differently or hit differently in different jurisdictions. So obviously important to get that right. With the US, for me, I did live and work in the States for a number of years, and my main observation to clients going into the US is broader than transfer pricing. Effectively, depending on what you want to do, you might create nexus in a whole bunch of different states in America, and you might trigger a whole load of reporting obligations as a result. So when I worked in-house in the US for a couple of years, the day I arrived, there was a stack of 120 different state, federal, and local tax returns due to the different activities they had in different states. So there's practical issues as well in the US in particular. I often as well have clients ask me about ultimately how much profit should sit in the US from a transfer pricing perspective. And it depends what the business does. If it's a business in the US that's going to be what we call entrepreneurial in nature, it might have a more volatile return but a higher return over time. If it's a more limited risk business, then you generally expect a lower profit number, but a more consistent profit number over time. And that's again where the intercompany legal agreements come in. There's certain types of risk that you can manage probably in multiple jurisdictions. So things like inventory risks and stuff like that. Foreign exchange risk is one. You can fund the overseas subsidiary just in US dollars and manage the FX risk on the Australian side, for example. And there might be other types of risk that ultimately you can manage out of Australia. If you set up your contracts in such a way that the legal agreements articulate those risks as being managed out of Australia, the US subsidiary ends up being a limited risk business, which would have a lower profit margin over time from a transfer pricing perspective. So yeah, a couple of thoughts on the US from me. It's one of those markets that many clients look to go into because of the size of the market, but it certainly comes with more than its fair share of complexity and paperwork, in my experience. Leonie, your turn. Moving on to slide cross-border movement of goods for practical example number 1. It's slide 9 in my deck for those of you following along at home.
Thanks, Michael. US is obviously very topical at the moment. So if you are dealing with the US, and in fact this is true of other jurisdictions as well, but when you structure your arrangements from a transfer pricing perspective, the question becomes, well, what else can you split out from the price? So Michael's previous slide alluded to various management services, service agreements, intellectual property, rights to distribute. Many of those things, if they're not included in the price, actually can be taken out of the price of the sale of goods into the US market. That does require benchmarking of those services and other fees that you might be charging separately, and certainly does require legal agreements to underpin that. But what you can do is actually reduce that customs value by bifurcating your price. And in other words, you may reduce the 20, 25, who knows what number it's going to be, tariff on the goods that you're exporting into the US. So it's certainly worth working with transfer pricing and customs when you are moving goods to kind of go through, actually, if we can reduce the customs value, how do we do that and how can we support that? We call that unbundling. So if anyone wants to, think about that, just think of the word unbundling. You're basically unbundling your value. Certainly the US Border Protection and most other jurisdictions are used to that. It's not incorrect to do that with your value. Other things to think of course, are tariff rates. So we do know that certain products going into the US will attract much higher duties. You might go into the US, but you might have manufacturing facilities, for example, in Mexico or in Canada or in China and Australia for certain goods. They will attract higher duty rates. There are additional duties in addition to the general duty rate that would apply. The Incoterms are really important. So when you're working with your clients on putting your legal agreements in place, for me, one of the things we always try to say to our clients is don't use delivered duty paid terms for long-term contracts. Why? Because once again, our crystal ball is not working so great, and we don't know if you're then going to be stuck with additional duties that you're not able to recover in the price of your goods. So Incoterms and terms of trade are also important.
Great, thanks, Leonie. Moving on to the next slide, practical example 2, establishing a foreign branch. I think, Gary, it's fair to say this is a typical chestnut that comes up when a client's looking to expand offshore. Do I want a branch or do I want a company? What do you generally answer that question?
In most scenarios or most client situations, the starting point would be that from a tax perspective, the outcomes are likely to be pretty similar. You want to model it to confirm that and validate it with the overseas office. But most jurisdictions would look at a company and a branch and say, we don't really want the outcomes from their perspective, from that country's perspective, to be different because that country doesn't, and just like Australia, wouldn't want there to be an arbitrage opportunity. And so then it falls to, well, what are the commercial reasons that a company is preferred rather than a branch? And not being lawyers, but knowing enough to be dangerous, we would usually say, well, at least you shouldn't be exposed to legal risk beyond the corporate veil if you set up a subsidiary. Not the right person, or the right advisor to be advising on that, but that would be a starting point of the discussion. You should speak to your lawyers to confirm that that's the case. But I have had situations where clients have said, well, my customer contracts are with the Australian company and I don't really want to reassign them or redo them because they might see that as a commercial risk. So they'd actually rather just set up a branch if the tax outcomes work out to be about the same. And that has happened. It doesn't happen very often, but it happens often enough that we can't really discount the possibility of a branch structure being deployed rather than a corporate structure.
Yeah, thanks, Gary. And if someone asks me a similar question, branch versus company, practically they often end up with a branch in the initial first couple of years just because of the speed to market versus the admin of getting things set up for a company. But my preference is always to get to that company stage as soon as you know that the business overseas is going to be successful. From a transfer pricing perspective, the outcome should be similar. In other words, the amount of profit returned for a branch versus a company should be similar. But the way you get there in a branch situation is by attributing actual income and expenses at the head office. Now, that's different to a subsidiary where you actually book transactions with that subsidiary. So what that means is there's technically more risk associated with the branch because the entire P&L of the head office is arguably up for grabs by the overseas tax authorities in terms of them arguing what should sit in the overseas branch. So in other words, a branch doesn't ring fence the income and expenses of the overseas activities in the way that a company would. And I said there, we have to attribute actual income and expenses. So that means that you can't make up notional transactions between a head office and a branch. In other words, if there is no royalty payment made by a head office, you can't put in place a royalty payment between an Australian head office and its branch. The Australian rules just don't work that way. So the outcomes might be similar, but there's certainly some nuances to be aware of. Leonie, any quick comments on branches before going on to first sale?
Look, certainly from a customs perspective, if you're transferring goods into market through a branch, there is a requirement to determine your customs value. So there's no sale, there's no price. So we don't ever recommend a branch because you end up having to go through the hierarchical methods of customs valuation. That can actually lead to a much higher customs value than you might otherwise have if you were selling to a subsidiary, because it can be based on the market price that you've sold in market, or can be a manufacturing cost plus, but without the ability to bifurcate the prices like you can, like we spoke about previously. So certainly from a customs perspective, we don't recommend branches. Those of you who are dealing with businesses in New Zealand that have branches, New Zealand Customs is always looking at whether goods are flowing through a branch and has the customs value been determined accurately. And more often than not, it hasn't been. The goods might go through at actual cost, and that's not the right way to value the goods. So branch leads to risk in the world of customs.
Thanks, Leonie. We've talked a lot about risks, but moving on to slide 13, it is in my deck. The heading is opportunities, not just risks, because, hey, we like to have carrots to go along with our sticks in tax world. Would you like to talk about first sale for export briefly, Leonie?
Sure. So, I mean, it goes back to what we were saying earlier around having the ability to reduce your customs value. This is a program that is available in the US, provided certain criteria are met. So in the slide, we have a third party, or can be related, manufacturer. They sell the goods to Australia, but they drop ship, so ship directly to the importer in the US, and Australia then sells goods to the US importer. The US program, First Sale for Export, allows you to use the sale price as the customs value from the manufacturer to Australia. So basically the first sale in that. That can lead to some considerably reduced customs values and hence opportunity to reduce US duties. It is a complicated program to participate in, but those who do actually find that there are significant benefits. But you do need to evidence things such as bona fide sales between the parties, that the goods that were produced in the other jurisdiction were actually intended always for export to the US. So some hoops to jump through, but certainly can give rise to a significant reduced customs value and duty opportunity in the US. And happy to talk to anyone about it if later date, because I know we're running really short on time.
Yeah, thanks, Leonie. That's the call to action. We're certainly seeing a number of clients very concerned about the Trump tariffs. So things like first sale on the duty side absolutely are things that we should be talking to those clients about. And Leonie is certainly our expert in that area. So all of our contact details will be made available after the webinar here. And we are all delighted to have conversations with any of you that might have clients facing practical issues. Generally, we're happy to have a chat. If there's an opportunity to provide a scope, we'll do that after. But certainly happy to hear from anybody that has questions that we can help you with. Now, running towards the end of the presentation, I'm conscious we started a few minutes late, so we're probably going to slightly overrun by maybe another 3 or 4 minutes. I do encourage you, if you've got questions, please put them in the Q&A. Leonie's got a question.
I need to jump off because I'm actually running a Trump tariff session at midday, Australian time. So I'm sorry, and apologies to everyone for the slowness. But Michael can wrap up, and Gary can wrap up my side as well.
That's it. Thanks, Leonie. So any questions about duty and customs, feel free to reach out to Leonie directly afterwards.
Thank you.
Any questions about transfer pricing or corporate tax, you're welcome to drop those into the Q&A now. I think the last slide we had was just a few sort of final thoughts / war stories in terms of things that we had seen. So again, stick your questions in and we'll jump to those if any pop up. But in the meantime, we'll just talk through those final thoughts. Maybe I'll pick one, Gary, then you can do one. The first one from me was the tax landscape has changed significantly in the last few years. Old-fashioned tax planning is not fit for purpose. So the reason I say that is because I still see across my desk structures that were set up, 10 years ago, sometimes even 5 years ago, that just don't work given the changes in the tax landscape. That can be because of hybrid mismatch rules. It can be because of changes to anti-avoidance related rules. It can be just because of changes to plain old transfer pricing rules. But generally anything that has a Bermuda or a Cayman Islands, it doesn't have people, it's got profit going through there. If there's large loans, all of these things are very, very difficult in the current world and probably don't work anymore. So if you've got clients that have what I would call quote unquote slightly outdated tax related structures, I definitely recommend that you have a quick workshop to see if that's still fit for purpose. Gary, final thought from you?
Yeah, I think similar sentiment. The tax rules, whether because the rules themselves change or the interpretation because of a preeminent case, can cause a structure that has been treated in a certain way to suddenly have a problem. And nothing sinister. I've had clients who've had overseas companies where they just manage or decide what that company does in Australia, and historically that hasn't been a problem in terms of that company's corporate residency. But a few years ago, there's a High Court case that dealt with essentially corporate residency, and that's really caused some clients who didn't have their structure reviewed, and quite possibly the tax advisor involved may not have been aware to have a look at it. And there might be foreign entities that have an Australian tax exposure because of not addressing that as quickly as possible and trying to change their business practice to reflect the change in the landscape in terms of tax law. So same comment as you, Mike. Things change all the time, and you can't rest on your laurels, unfortunately.
Yeah. Haven't seen any questions come through, so maybe one more quick final thought from me. The tax rules are generally not up to date with how business is done in a digital world. That increases risk. Where that's really playing out at the moment is the tax office in Australia has some very strong views about what payments to related parties overseas should constitute royalties. Basically, there was some guidance issued 20 years ago that if you buy a CD to install software on your computer, that shouldn't be a transaction that attracts a royalty. But in this current world of digital downloads and cloud-related this and that, there's a far, far greater scope for transactions to attract withholding tax. So things like that as well, where even the commercial landscape has changed, the tax rules haven't necessarily kept up, can lead to some interesting consequences, where basically your clients might have been absolutely fine for a number of years, but all of a sudden the landscape has changed and they might be on very uncertain footing. All right, Gary, conscious of time, you got any last quick final thought before we sign off?
No, just like to thank everybody for attending and sticking with us for the last hour with the technical difficulties that we've experienced.
That's it. No, thank you all. So again, our contact details were made available after this. Hopefully we covered some topics that piqued your interest. You will see from the remaining slides that the typical project plan we had on the first page, we actually put in the proper order towards the end there. So that's something that you can absolutely have as a reference point going forwards, where you have a client come to you and talk about going international. We're obviously delighted to help you guys with any of those steps as you need assistance. We at BDO don't have a law service offering except in migration services, which is a niche offering. So therefore, we often work with legal firms fairly closely hand in hand on some of these issues with their clients and vice versa. They work with ours. So looking forward to connecting with some of you following the webinar here. And obviously delighted to continue the conversation if you have questions, thoughts, comments, or challenges to discuss. Otherwise, thank you again. There will be an email that comes around afterwards. Thanks for bearing with us for the technical issues, and we'll see you soon. Thank you. Bye-bye.